Hey guys, welcome to the channel and welcome back to another video. I want to talk to you guys about the warning that the Federal Reserve just gave to all Americans about the fact that, hey, we're going to keep raising rates until inflation is under control. So before we get started, guys, if you're stopping by this channel for the first time, please consider subscribing to the channel. Also, smash the like button and hit that notification bell so that every time I upload a video, you'll be notified. Just a couple of days ago, the Federal Reserve went ahead and increased interest rates again. They increased the interest rate by 75 basis points, which is 0.75%. Now, the significance of that is this. That is the fifth increase this year that the Federal Reserve has imposed, but also it's the third increase of 75 basis points, or the third increase of 0.75% in the last 3 months. Now that says something. It also says something that the Federal Reserve went out and said in their press conference that we're going to do whatever it takes and we're going to continue to raise rates until the inflation rate is at 2%. Now, what that says is this, guys. We know that inflation has been hovering around 8%. It's been as high as 9%. But the Federal Reserve says, hey, we're going to keep raising rates until it's down to 2%. Now, that tells us it's going to be a while before rates go down. It also tells us that the rates are probably going to continue to rise and go up. Now, my question before the other day ago was, how far is the Federal Reserve willing to go to control inflation? Well, we got our answer, and I got my answer. They're willing to go as far as it takes. So let's backtrack just a little bit and talk about what is the federal funds rate. The Federal Reserve doesn't actually go out and raise the rates on mortgage rates and raise the rates on auto loans, right? What they do is they raise the federal funds rate. What the federal funds rate is, it's the interest that banks charge one another for overnight lending of their reserves to other lending institutions and other banks. It's what they charge each other. And the Federal Reserve has the power to change that rate. That's called the federal funds rate. Now, when they change that rate, those banks and lending institutions, they trickle that down to the rates that they charge customers like me and you. So in turn, when that federal funds rate goes up or down, fixed rates like mortgage rates and auto loan rates, those go up and down. And even the variable loan rates on things like credit cards or maybe even some student loans, they go up and down. So there's sort of a trickling down of when that federal funds rate changes, it changes the interest rates that lending institutions and banks charge its customers, its consumers that want to get loans from them. I mean, the mortgage rate at the beginning of the year was probably around 3%. Now it's around 6%. That can be major, right? So that means that you might have got a $300,000 home loan at 3% interest, and your payment was maybe $1,400 on that loan. Well, now at 6%, that loan might cost you $1,800 per month. Now that's significant. Now that little 3% increase in that mortgage interest rate meant a whole $500 a month. Now that's significant because it causes people to say, you know, maybe I don't need this loan, and it discourages borrowers. So let's talk real quick about what the Federal Reserve is and what they actually do. The whole purpose of the Federal Reserve is to monitor and manipulate the money, basically, okay? And what they do is they call it price stability. Now, this price stability means manipulating and monitoring and changing interest rates, all these things to kind of make sure things stay balanced, so to speak. So as prices increase, like inflation, prices continuing to go up. When inflation is happening, the Federal Reserve steps in to take certain measures and steps to control pricing, right? And as we know, the price of everything is increasing. The price of milk, the price of bread, the price of housing, the price of energy, the price of medical services. Everything has been increasing, and some of the reasons those things are increasing is because of high demand. And oftentimes when demand is high, prices are going to go up, right? Think about it. If you own a business selling tables and there's a high demand for tables because the economy is strong and everybody is out working and unemployment is low like it has been, if you sell tables and that's your business, you're not going to decrease the price of tables when demand is high. Not at all. You're going to slightly increase your price of your tables. And the reason you increase the price of your tables is to make more money, more profit. And as long as everybody keeps paying for your tables as they increase in price, you're not going to slow down increasing your price. This is why businesses keep raising prices, because people keep paying for the increased price. Because our economy is strong. People have buying power. People have jobs. The unemployment rate is a little over 3%. So the unemployment rate is low. That means people are working. People are making money. There's been lots of money infused into the economy lately in the last couple of years. And so people have buying power. They got the money to spend. And if they have the money to spend and I have a table company, my prices are going to keep going up. So what the Federal Reserve does is they swoop in and try to control pricing. And one of the ways they control pricing is by controlling demand. And they control demand by raising interest rates. If they make money more expensive to borrow, which is all the interest rates are. Interest rates are the cost of money. So if they make money more expensive to borrow, less people will borrow. That means less people will buy. That means less people are going to go out and get the 6% mortgage than they would at the 3% mortgage. So if we keep raising interest rates, it's going to control our consumption. It's going to control our borrowers. It's going to control the amount of money people are willing to go out and buy. It's going to control the amount of loans that people get. People are going to get a lot less loans when money is more expensive to borrow. That's the whole purpose of why the Federal Reserve keeps raising these rates. It's to slow down American buying power. And if they slow that down just a little bit, it can kind of balance things out. Basically, they're trying to slow down consumption. They're trying to slow down the rate at which we consume by making money more expensive to borrow. If money's more expensive to borrow, you're less apt to go out and get that mortgage loan. If money is more expensive to borrow, you're less apt to go out and get that car loan or to spend on your credit card purchases. When you look up and your credit card interest rate was 10% 6 months ago, but now it's 15%, well, guess what? You're probably less apt to borrow more and more money. This is what the Federal Reserve wants, because the more you borrow money, more inflation is going to continue to rise. So they raise rates to discourage spending. That slows demand, that lowers prices. That's the whole point in why they're willing to keep raising these interest rates, because they want inflation to go down. And inflation is only going to go down if people stop buying the tables, back to that example, the tables that I'm producing. Because if people stop buying them and the demand slows down, then guess what? I'm going to lower my prices because I want to sell tables. Now that example goes for every single thing in the economy for the most part, right? Housing, cars, you name it. They're going to go down in price if demand goes down. And that's their whole point. So what does that mean for the average consumer? For us right now, it basically means this, guys. Understand that fixed rate loans on things like mortgages and cars, they're going to continue to go up for the foreseeable future. You're going to be paying more for that mortgage and more for that car loan and more for your variable rate loans, like maybe some home equity lines of credit or a credit card. All those rates are going to continue to rise. The Federal Reserve has already warned us that rates are probably going to go up. So you need to be preparing for that and thinking about that in terms of your long-term planning for things like mortgages and cars and things like that that you may plan on borrowing on. The Federal Reserve has sent their warning. They said, hey, we're going to keep going and it's not going to stop until we believe inflation is down to 2%. And we're at 8%. And just a couple of months ago, we were at 9%. So 2% is a long way to go. That's the Federal Reserve's warning to us. Hey, again, guys, if you're stopping by this channel for the first time, consider subscribing and also smash the like button and share the video. So, hey, the best person to take care of the old you is the young you. Stay up to date on the Federal Reserve. See what's going on with the economy because it's going to affect all of us. All right? You guys take care of yourself and take care of other people. Until the next video, peace.